You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Erik Lundh, Global Senior Economist at the Conference Board and guest host of today's episode. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our own outlook for the global economy. Joining me today is Stephanie Guichard, Senior Economist, Global Indicators at the Conference Board. Welcome, Stephanie.
Hi.
So, Stephanie, we had some new data come out this morning, U.S. consumer confidence. There was some financial turmoil earlier in the month. We heard more about recession risks and employment gains slowing. Has it changed consumers' view of the U.S. economy?
Well, not really. So that's kind of the good news. Overall, consumer confidence was not really affected by the financial ups and downs of the beginning of the month. Nor by the recession chatter. Consumers took stock of the financial market turmoil. We saw more references to the stock market in the writing questions. We saw that they kind of slightly changed their view about the stock market. They were less upbeat in August than they were in July or June. However, overall, confidence has improved a little bit, but it's kind of in the same narrow range where it has been for the past 2 years.
Okay. So, what were some of you mentioned there were some slight movements. What caused the movements in the overall measure?
So, this measure of consumer confidence has two main sub-index. So one is the assessment of consumer of the present situation, and the other one is their expectations.
And so what drove the changes for the present
situation? So they
situation?
both improved.
Okay.
They both improved.
Okay.
And instead of going one sub-index and the other, I want to take you through the whole picture. So when we look at these in details, what we see is for both the present and the future, consumer had a better assessment than in July about business conditions. So they were more optimistic about business conditions right now and in the future. And this is what has driven the index up. However, there is another component in both the sub-index, which is the assessments of the labor market. And what we saw is that both for the current situation and the expectations, consumers have become a bit more concerned about the labor market. Mm-hmm. For the present situation, they are still positive, but less so than a few months ago. And for the expectations, they were already quite pessimistic, and they have become slightly pessimistic. And we think this is really linked to, the recent slight increase in the unemployment rate, mm-hmm. which is affecting their assessment. They see that there are fewer jobs available than a few months ago. Even if there are still plenty of jobs available, they focus on the difference. So.
Sure. And they're also reading about these headlines in news
exactly.
as well. Yeah,
exactly.
So is the cooling of the labor market affecting consumer confidence moving forward?
So yes, so we see this impact, and we've seen it, in terms of the expectations, we've seen this impact for a few months now. We see some cooling on the labor market, and then we see consumer expectations deteriorating.
And what are consumers saying about recession risk? Because that's a topic that's kind of reemerged as a concern in the media, at least.
So nothing more than in July. So we started asking consumers about recession risks 2 years ago. So we don't really know, we don't have a full picture of the series. But what we saw is that in August, it was stable, same level as in July, and it's way below the peak that we saw last year.
And we're seeing actually a similar trend in the CEO confidence numbers too, right?
Yeah, CEO confidence is more like a switch where they were 80% to forecast a recession a bit more than a year ago. Now it's just 30%.
Yeah.
So they have completely changed their mind about recession risk. For consumers, we still have 2/3 of consumers that say that there may be a recession coming. But again, we have just started to ask these questions 2 years ago. So
it's hard to know
maybe
what the
that's the
baseline
low.
is.
Yeah, we don't have the baseline. So
Yeah.
maybe that's the low point.
So you mentioned the stock market. How are consumers sort of thinking about the stock market going forward?
So in July, over 50% of consumers were expecting the stock market to increase in the next 6 months. Now it was just about 47%. So they have kind of reassessed their views about the stock market. And we saw also an increase in the share of consumers that were expecting the stock market to deteriorate in the next 6 months. So they have kind of changed their views. They were very upbeat about the stock market, and now they are a bit less upbeat about the stock market.
Well, they did have some things to grapple with over the last month on that front. So.
Yes, exactly. And we've seen it in the past. Typically when you see this kind of volatility in the stock market, at the time the survey is in the field, because the survey was in the field from August 1st to August 21st, we see some kind of reappraisal of the stock market. And if the stock market rebounds at this time, typically then the consumer assessment just go back to where it was previously.
We'll see what happens.
We'll see next month.
Hopefully, we don't have another upset like that. What about inflation? How are consumers thinking about the future of inflation and interest rates?
So we saw some improvement on that front. So the consumer inflation expectation for the next 12 months has declined substantially. I mean, it was 5.3%. Now it's 4.9%, which is the lowest level since the beginning of 2020, so just when the pandemic started. So that's an improvement. And they see that prices are still increasing, but not as fast as in previous months. So we think this is what is driving their expectations. And then
on interest rates.
And then on interest rates, same story. We saw so on average they still expect interest rate to increase, but less so now than last month and the month before.
Okay.
So they have started to switch their view on interest rates also. But just to be clear, I mean, when we talk about interest rates, they don't necessarily think about the Fed.
Sure.
They think about the interest rate they are paying when they buy their car, when they want to buy a house, or on their credit cards. So it's not a one-to-one relationship with.
No, I gotcha. Because we have seen a little bit of progress there. Mortgage rates are starting to slip a little bit. And of course, at Jackson Hole last week, we had Chair Powell talk a little bit more dovishly about rates. And we'll talk about that, though, later on in the episode.
And the survey was fielded before Jackson Hole.
There you go.
We'll see next month.
Gotcha.
Maybe they're going to be even more.
And in terms of finances, how are consumers feeling about their finances? Which captures on that kind of employment and inflation theme.
Yeah, so that's a new question that we started to ask also 2 years ago. And what we saw is that they were a bit less positive about their current financial situation, but more optimistic about the future. So it's really mixed feeling from consumers. So present bit not as good as it used to be, but the expectations for the future improving. So
okay. So we also do write-in comments.
Yes.
Where people who are taking the survey can put whatever they really want in the comment section. Are there any zingers or interesting takeaways from what we're seeing from the comments?
Yeah, and I mean, it's not that they can write whatever they want. We are asking them what is driving their view of the U.S. economy. And by and large, references to inflation, prices, food prices, energy prices are still dominating the answers we get. So
it's still
that's kind of the main theme.
Yeah.
This is affecting their views about the economy, positively or negatively. So most often it comes with references to elevated prices, increasing inflation. So it's kind of negatively affecting their view of the economy. But this month we saw also some slight changes. So first we saw a decline in the references to inflation and prices, although it's still very high. We saw some decline. And we also saw some references to other themes that were spiking a little bit. So you mentioned it earlier, the stock market we saw a spike in references to the stock market, which makes total sense.
Yeah.
And we also saw a spike in references to employment and unemployment. So that makes sense too.
It does. It does. What about, so we're in an election year, we're moving towards November. Were there anything interesting said about the political environment?
So in the writings, we're also tracking references to the political situation or to the elections. And I would say consumers are still not focused on the US elections, especially when you compare it to 2016. In 2016, we got much more writings mentioning the inflation, the election, the president, this kind of thing. In 2020, no, because at the time, everyone was talking about the pandemic. So, I mean, most of the answers we got to this question, what is affecting your views of the economy, was COVID, the pandemic.
Okay.
So now we are in 2024, and we don't see so many references to election or the politics in general. We see some slight increase over time, but nothing near where we were in 2016.
That's really
because they still focus on inflation and prices. So it's really what is dominating your view that we see in this writing. So if we look at the trends for the past two elections for which we have collected this writing, it increases slowly over time. So we should see some increase. We saw some increase even in 2020 when everyone was focused on COVID and lockdown and everything. We saw some slight increase over time in the months leading to the elections. So we may see more references in September, October, November, and then it continues typically until the end of the year and the new administration comes in.
Okay. It'll be interesting to compare it to 2020 and 2016 when we have you know deeper into election territory this year. What about buying plans, especially with things like durable goods, refrigerators and cars and things like that? What are consumers saying about that?
So consumers are still not really too keen on buying a car, especially new cars. So we ask them, are you going to buy a car in the next 6 months? And it's much less answering yes than pre-pandemic, and especially for new cars. I mean, I think used car has gone back to the pre-pandemic level, but not new car. And it's a combination of the price of the cars and the interest rates, because most often you need to finance your car. So it increased slightly in August, but I mean, that's really minor.
Okay.
So before we go to durable goods, we are not planning to buy houses either. Intentions to buy a home has reached a new low, like it's the lowest in 12 years. And that's still the interest rates and the higher house prices effect. On durable, so we saw some kind of a slight improvement this month, but it's focused on some, it's not across the board. So we saw some increase for dishwasher, TV, and refrigerators.
Okay, that's probably me. My refrigerator's going out.
Yeah.
So, yeah.
Yeah, and it's also, we saw some decline in the price of these goods in the past few months. So, if you've been waiting since the pandemic when you couldn't buy one because there was nothing available, and you push your appliances to the limit, maybe that's a good time to buy it. And we also saw some interest of consumers in buying laptops and smartphones. But we are still not back to, the first year of the pandemic where everyone was buying a new phone, a new laptop, everything. So we are not back there yet, but we saw some improvement.
Okay. And so what does consumer confidence tell us about household spending this year?
So I would say they're going to remain cautious. I mean, the improvement I'm describing, they are very limited. So they are going to remain cautious. However, since we think that, it's the prices and the interest rates that are really affecting their buying plans, but also their concerns about the labor market. So it's you need to see how the things are going to evolve. Obviously, if the labor market deteriorates more, they're going to go to the more cautious side of the story. If the labor market only cools a little bit as we are expecting here. And at the same time, they see inflation slowing, they see some decline in some durable goods, and they also see lower interest rates, which would allow them to finance this purchase. Maybe they're going to move to the more slightly optimistic side. So
Sure.
Still mixed feeling, and see what happens.
Okay. And then, so final question, anything that we missed, any big takeaways from the August Consumer Confidence Survey?
So I think the good news is that consumers didn't react to the stock market turmoil and the recession chatter earlier this month. So that's, to me, that's the big takeaway. And the other one is confidence is still hovering the same narrow range of the past 2 years. So it improved, but it's still not time to celebrate.
It wasn't a breakout.
Yeah, exactly.
Gotcha. Well, thank you, Stephanie. We're going to take a short break and be right back with more of my conversation with Stephanie. And she's going to actually turn the tables a little bit and ask me a little bit about our forecasts for the global economy.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm Erik Lundh, Global Senior Economist at the Conference Board. I'm joined by Stephanie Guichard, Senior Economist, Global Indicators at the Conference Board. Stephanie, we just talked a little bit about consumer confidence, but maybe we can turn the tables and you can ask me a little bit about our forecasts.
Yes, exactly. So we just discussed the new findings of the consumer surveys. So how does it align with the Conference Board views of consumers in the 2024 and 2025?
Sure. No, it's an interesting question. We are concerned about the U.S. consumer. Following a really roaring consumption spree that took place in 23 and in 22, we're starting to see perhaps a little bit of a pullback in some of the data in early 2024. What's interesting is that last year consumers powered through high inflation and high interest rates and just kept on spending. But we're starting to see some of the drivers behind that trend start to give a little bit. One of the big drivers last year was pandemic excess savings. This is basically a large amount of savings that was aggregated over the course of 2020, 2021, as consumers received stimulus from the government, as they maybe didn't spend as much as they had previously. So they built up a pretty large war chest of about $2 trillion or so, and they've spent that out over the subsequent years. In 23, especially, we had large parts of the year in which income growth, while elevated, wasn't keeping up with consumption growth. And so to sort of bridge those two variables, consumers spent out that savings. And they also started to pile on debt again. In the aftermath of the pandemic, we saw balances on things like credit cards and auto loans go down because people had excess money to maybe pay off, the last few payments on their car or put their credit card balance to zero, but that has reversed. This year, we've also started to see consumer debt start to rise, especially with credit cards, and also we've seen defaults rise on auto loans and credit cards as well. So these are some concerning trends that we've been watching. And as we move into sort of the second half of 2024, we're concerned that the U.S. consumer is going to run out of steam to a certain extent. They're going to have to not pull back spending a lot, but they're going to have to be more careful in how they spend. And so the sort of contribution to overall GDP associated with consumer spending is probably going to wane a little bit. Again, not going necessarily negative, but soften relative to what we've been used to seeing over the last year or so.
And so the fact that, I mean, we've seen this kind of small increase in consumer confidence, you're like us, you see it as...
I see it as reflective of where we are presently.
Okay.
But I think, moving forward, there's going to be some hard decisions that households are going to have to make in terms of balancing spending versus balancing debt payments versus perhaps cooling income growth and things like that. So I don't think that, again, we don't expect consumer spending to fall apart by any means. But we do think it's going to soften over the course of the second half of this year.
Okay, so overall, I mean, what's your outlook for the U.S. economy?
So even though we are expecting to see a softening in consumer spending, we are not forecasting a recession for the U.S. economy. We think we'll see a slowdown in the third and fourth quarter of this year, something along the lines of 1 to 0.5% quarter-on-quarter annualized growth. So there will be a bit of a lull, but we haven't really talked about interest rates too much at this point in terms of some of the signals we've been getting from the Fed. We are expecting to see interest rates start to come down starting in September consistently over the course of the rest of this year and into 2025. So we think that will put a sort of bookend to the amount of weakness that we see. You mentioned that consumers are grappling with high interest rates in terms of their decisions to perhaps buy a new car or buy a new home, especially. So as those rates continue to come down, we think that it's going to sort of put a bookend to the weakness and keep the economy from sliding into recession, so that over the course of next year, we think we'll see a reacceleration in growth as GDP approaches something along the lines of 2% or so, which is roughly the potential growth rate for the U.S.
Okay, so let's talk a bit more about the forecast, but more the global forecast. So I was curious, what's your forecast for the global economy and which economies are going to be driving it?
So that's the second part of that question is really important. Overall, we do expect to see global GDP growth hover fairly stably at around 3% or so this year. So no big acceleration or deceleration in that, but it really depends on where in the world you are. So I already mentioned the U.S. We are expecting to see a little bit of a deceleration in economic activity over the course of the second half of this year. But on the flip side, in Europe, for instance, we're expecting to see the economic growth situation improve a little bit. And it really varies from place to place. So in Latin America, we're expecting to see cooler growth this year, but we're expecting to see improvements in Middle East and North Africa. Growth in Asia is slowing somewhat, but it's still going to be the largest driver of growth for the year. And so overall, growth in advanced economies, we think, the U.S. and parts of Asia, Japan, Korea, Europe, et cetera, should be fairly stable overall. Meanwhile, we're expecting to see growth in developing economies continue to outperform relative to the bigger, more advanced economies.
Yeah, so I mean, emerging markets outperforming advanced economy, this is kind of standard. In a way, it's kind of emerging and developing economies have more room to catch up. Is there anything else behind this better performance of emerging economies, or if it's just the traditional catching up story?
I think it's a bit of. There's a lot of truth to what you just said. I agree. Economies that are emerging, by default, typically have faster growth rates because they're continually integrating technologies and best practices from advanced economies that allow them to push forward more rapidly. While for advanced economies, they have to innovate and push that frontier forward. Yeah. So it creates a bit of a two-story kind of situation in terms of developed versus advanced growth rates. But overall, I think that's sort of what we're thinking at this point. We are expecting some emerging markets potentially to slow a little bit. I mentioned Asia. China has been slowing. We just downgraded India a little bit as well. So yeah, it is that classic story, but there are nuances for each economy, of course.
Okay, so let's talk about China. I think you are still forecasting 5% growth this year, which is kind of the government forecast.
Sure.
And we read here and there that there is no way they're going to get that. So let's discuss that.
So that's actually that forecast is produced by our economists in Beijing. And you're right, we have been seeing a lot of difficulty in the Chinese economy. Over the course of the first half of this year, in Q1 and Q2, we saw growth slip a bit, still around 5%, but the sort of trajectory was one in which we may actually see it slip even further in the second half of this year. And a lot of this is associated with a lapse in consumer confidence, in consumer spending, which is sort of to a certain extent underpinned by some big problems in the property market in China in terms of prices falling, and Chinese put a large store of their wealth in the property market, so it's really hurt that. But at the conclusion of the third plenum, which is a big government meeting that takes place every few years, just concluded about a month ago, and there were some references to increased fiscal and monetary support moving forward. So we think that in the second half of that year, we'll start to see some of those programs have more of a bite, which will kind of keep that 5% growth trend on course over the course of the second half of the year as well. So for the full year of 2024, probably close to that government target of about 5%. But next year and beyond, I think we'll see some of the classic headwinds that we just noted, coupled with some demographic issues, really start to continue to moderate the growth rates that we're seeing coming out of China.
And can we talk a bit about exports?
Sure.
The most recent numbers were not so great. So does it mean that China is not going to be able to get growth from the rest of the world?
So exports have been an important dimension of the Chinese growth story over the course of last year and the beginning of this year, driven by things like spending in the U.S. and in other parts of the world, big demand for durable goods. But as consumers in the U.S. and elsewhere potentially pull back a little bit, which is what we're forecasting, especially here in the U.S., that is going to have an impact on Chinese exports. So that's a factor. And then also we have trade tensions that have gotten a little bit worse between not just the U.S. and China, but China and other parts of the world as well. And so if you have tariffs that are implemented on Chinese imports, it's going to, of course, affect their ability to sell things globally as well.
Okay, so let's switch to inflation. So what's happening to inflation globally? We tend to focus here on U.S. inflation, but what's happening globally? Is it slowing?
Overall, it is slowing. We are seeing progress, in many parts of the world. You mentioned the U.S. We do forecast that in the U.S. We'll continue to see inflation ebb. Our expectation is that sometime in mid-2025, we'll get to the Fed's 2% target. In Europe, the inflation rates are still elevated above where the ECB would like to see them, but we are optimistic that we'll see progress there as well over the course of the next year or so. But in other parts of the world, we were just talking about China, for instance. China's struggling with disinflation. We have negative inflation rates, both for consumer and PPI in China, reflective of some of the economic struggle that they're having there. So it is a little bit of a mixed story, as is the case with the global economy with any kind of lens you're looking at it through. But overall, we are optimistic and do expect to see continued relief globally on that inflation front.
Okay, as you just mentioned Europe, so the ECB has already started to cut rates, and the Bank of England too.
Sweden and Switzerland, and
Okay, so do they see better progress on inflation than the U.S., or what's the story there?
Sure, that's a great question. The ECB decided to move a little bit faster than the Fed did. The Fed, in the U.S., we had a bit of a hiccup in the first quarter in terms of the inflation story here. So we had a lot of progress on inflation last year. It continued to decelerate. It accelerated a bit at the beginning of the year, which maybe threw off the Fed a little bit in terms of their ability to cut interest rates. At the start of 2024, expectations were that we would see interest rates cuts by the Fed over the summer period. But after that kind of the speed bumps at the beginning of the year, they're a little bit behind the curve in terms of getting to where the ECB is and where some of the other central banks are. So, moving forward, as that inflation narrative continues to see progress, Our expectation is that, not just here in the U.S., but in other parts of the world as well, overall, broadly speaking, we'll start to see interest rates come down. But again, we can look at the situation in Japan, which is very different.
I was going to ask you.
In Japan, we're seeing the BOJ increase interest rates. So, it's a very different kind of environment depending on where in the world you're looking. It's hard to make broad sort of, statements about the global economy when it's really just it's a puzzle full of little pieces. Of
course. And you mentioned interest rates are going up in Japan, but they are still extremely low compared with other countries.
Absolutely.
So overall, if we look at the big picture, so at the world level, growth is going to be stable, inflation is going to slow, and interests are going to
broadly come down.
Overall.
Yeah.
So wouldn't this be supposed to drive some acceleration in global growth in 2025?
Sure.
If you have this kind of 2024 is quite good in terms of growth, inflation is slowing, interest rates are being cut, so shouldn't we see an acceleration next year?
One would think that. That makes sense at the surface, right? You see interest rates come down, ergo growth should pick up. But you have to kind of remember that interest rates are quite high right now. They're in restrictive territory in many economies around the world. And they're in restrictive territory because we've had globally a wave of inflation that economies around the world have had to grapple with. And so these interest rates are high to moderate that inflation. That inflation, as you said, is coming down. And so the degree of restrictiveness that's needed around the world is less appropriate. And so we're seeing interest rate cuts, but we're not seeing interest rate cuts so severely that it's going to be stimulative. It's going to, what is being done is rates are coming down back towards a neutral kind of interest rate environment. And so because of that, you're not going to see a rapid acceleration in growth. You're going to see, hopefully, this soft landing concept where interest rates come back down towards neutral. Inflation comes back towards central bank sort of target rates, all without driving any economy really into a severe contraction. And that seems to be what's been happening in a lot of economies. There's been concerns, especially here in the U.S., that it wasn't going to be feasible, but the data have been favorable. And we're hoping for the U.S. and a lot of other places around the world that we're able to get back to that neutral interest rate environment without triggering major contractions or disruptions. To the audience, thank you so much for joining us. We hope you found this conversation productive and insightful. Stephanie, it was really great to have you here today, and we'll look forward to seeing you soon.
Yeah, great to be with you and to have you answering my question this time.
And thanks to all of you listening in to C-Suite Perspectives. I'm Erik Lundh, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.